The market took a nosedive today, leaving investors reeling. The sudden drop has sparked widespread concern among traders and financial analysts alike, as they scramble to understand the underlying causes of this dramatic shift. The Dow Jones Industrial Average plummeted by 300 points, a significant drop signaling a potential shift in market sentiment. This decline marks one of the most substantial single-day losses in recent months, raising questions about the stability of the current economic environment. The S&P 500, a broader market index, is also on track for its worst week in 3 months, reflecting widespread losses across various sectors. Investors are particularly concerned about the impact on key industries such as technology, healthcare, and finance, which have all seen notable declines. Meanwhile, the tech-heavy Nasdaq Composite experienced a substantial decline, further emphasizing the current market instability. The drop in technology stocks, which have been a driving force in the market's recent gains, suggests a potential re-evaluation of their valuations. Interestingly, amidst the widespread downturn, the Russell 2000, an index tracking small-cap companies, bucked the trend and saw a notable rise. This unexpected performance has caught the attention of market watchers, who are now speculating about the reasons behind this divergence. This divergence in performance suggests a potential rotation away from large-cap stocks, particularly in the technology sector, and towards smaller, potentially undervalued companies. Investors may be seeking safer havens in these smaller firms, hoping to capitalize on their growth potential in uncertain times. The market's reaction today highlights the dynamic nature of investor sentiment and the constant search for opportunities in a fluctuating landscape. As investors reassess their portfolios, the shifting tides of market dynamics become ever more apparent. This sudden shift in market dynamics has left many analysts and investors questioning the underlying causes and pondering the potential implications for the future. The uncertainty has led to a flurry of activity as experts try to predict the next moves in this volatile environment. Is this a temporary blip or a sign of a more significant market correction on the horizon? The debate rages on, with some experts warning of further declines while others remain cautiously optimistic about a potential rebound. Only time will tell, but for now, investors are advised to proceed with caution and carefully analyze market movements before making any significant investment decisions. Staying informed and vigilant will be key to navigating these turbulent times and making sound financial choices. The market's downturn has hit the tech sector particularly hard, signaling a potential shift in investor sentiment. This shift is not just a minor blip, but could be indicative of a larger trend that has been brewing beneath the surface for some time. For months, if not years, big tech has reigned supreme, driving market growth and investor confidence. Companies like Apple, Amazon, and Google have been the darlings of Wall Street, consistently delivering impressive returns and innovation. However, today's downturn suggests that this trend might be reversing, with investors potentially seeking opportunities elsewhere. The once unshakable confidence in big tech is now being questioned, and the search for new growth avenues is on. Glenn Smith, a market analyst, suggests that this shift away from big tech has been a long time coming. He points out that the signs were there, but perhaps overshadowed by the relentless upward momentum of tech stocks. Investors have been pouring money into big tech for so long that valuations have become stretched, he explains. The high price-to-earnings ratios and lofty market caps have made some investors wary, prompting them to look for more reasonably valued opportunities. A correction was inevitable, and this could be the start of a more sustained rotation into other areas of the market. This correction is not just a short-term reaction, but could signal a more profound and lasting change in investment strategies. This rotation away from big tech is further evidenced by the contrasting performance of the Russell 2000. The index, which tracks small-cap companies, has shown resilience even as larger indices falter. While the major indices tumbled, the Russell 2000, which tracks small-cap companies, managed to stay afloat. This divergence highlights the growing interest in smaller, potentially more nimble companies that can adapt quickly to changing market conditions. This suggests that investors are increasingly looking towards smaller companies with potentially greater growth potential as they become more wary of the high valuations and slowing growth prospects of some tech giants. Small-cap stocks often represent emerging industries and innovative solutions that can capture market share more rapidly. The shift towards small caps could signify a broader change in investor strategy. This change is not just about seeking new opportunities, but also about managing risk in a more uncertain economic environment. With interest rates rising and inflation still a concern, investors may be seeking value in companies with strong fundamentals and the ability to weather economic uncertainty. These companies often have solid balance sheets, consistent cash flows, and a proven track record of navigating economic challenges, making them attractive in volatile times. The tech sector is feeling the heat as the market downturn takes hold. The information investors, once enamored with the growth prospects of the tech industry, are now Amazon stock experienced a significant drop, with investors expressing concern. Report also saw its stock price fall, reflecting the towards the tech sector. This downturn in the tech sector. While tech stocks have delivered impressive returns, not indicative of future results. Investors are now a temporary setback for the tech sector or a sign of more challenging times ahead. Adding to the market's woes was an unexpected outage at CrowdStrike, a leading cybersecurity firm. This incident came as a shock to many, given CrowdStrike's reputation for robust and reliable cybersecurity solutions. The outage disrupted services for numerous clients, raising concerns about the reliability of the company's platform. Businesses that relied on CrowdStrike for their cybersecurity needs found themselves vulnerable, scrambling to find immediate solutions to protect their data. This incident sent shockwaves through the market, further fueling the downturn and highlighting the vulnerability of even the most established tech companies. Investors were quick to react, pulling out their investments and causing a significant drop in stock prices across the tech sector. CrowdStrike's stock price took a significant hit following the outage, reflecting investor concerns about the potential financial and reputational damage the company could face. Analysts began to question the long-term impact on CrowdStrike's market position and its ability to recover from such a setback. This incident served as a stark reminder of the importance of cybersecurity for businesses in today's digital landscape. Companies are increasingly dependent on digital infrastructure, making robust cybersecurity measures not just a luxury but a necessity. Interestingly, CrowdStrike's misfortune presented an opportunity for its rivals. Competitors in the cybersecurity space were quick to capitalize on the situation, offering their services as more reliable alternatives. Companies like SentinelOne and Palo Alto Networks saw their stock prices rise as investors sought alternative cybersecurity providers. These companies were able to reassure the market of their stability and reliability, gaining investor confidence and market share. This unexpected turn of events underscores the interconnected nature of the market and how one company's loss can quickly become another's gain. The ripple effects of CrowdStrike's outage were felt across the industry, demonstrating the delicate balance within the tech ecosystem. The CrowdStrike outage and its ripple effects highlight the importance of cybersecurity in today's digital world. As cyber threats become more sophisticated, the need for advanced and reliable cybersecurity solutions becomes ever more critical. As businesses become increasingly reliant on technology, ensuring the security of their data and systems is paramount. The incident with CrowdStrike serves as a cautionary tale for companies to not take their cybersecurity measures for granted. This incident serves as a wake-up call for companies to reevaluate their cybersecurity measures and ensure they have robust systems in place to prevent and mitigate potential threats. It is a reminder that in the digital age, the cost of a security lapse can be enormous, affecting not just financials, but also a company's reputation and customer trust.